$10,000 in Monster Beverage stock in the year 2003 turned into more than $9 million by 2013. Not 1 million, 9 million. A single 10 grand bet, one stock, 1 decade, enough to buy a mansion in cash and still have millions left over. And Monster isn't even the most insane story I'm going to tell you today. I'm Joe, and over the next 15 minutes, I'm going to walk you through 5 stocks that turned a $10,000 investment into $1 million or more in just 10 years. What they all had in common before they exploded, and the specific signals that, in hindsight, were screaming at investors to pay attention. Because here's the uncomfortable truth. Stocks like these aren't as rare as you think. They show up roughly every market cycle. The hard part isn't finding them after the fact. It's recognizing them before everyone else does. Let's get into it. Stock number 1, Monster Beverage, ticker MNST. In 2003, Monster was a tiny beverage company most people had never heard of. It was trading for around 4 cents per share on a split-adjusted basis. 4 cents. By 2013, that same share was worth about $60. That's a return of roughly 96,000%. If you had put $10,000 into Monster in 2003 and just left it alone, you would have ended that decade with somewhere north of $9.6 million. And the wild part? This wasn't some secret biotech or crypto play. It was a can of energy drink. You could literally walk into any gas station in America and watch the product fly off the shelves. Stock number 2, Netflix, ticker NFLX. In 2010, Netflix was trading around $7 per share, split adjusted. The company had just started streaming. Most analysts thought they were crazy to pivot away from DVD rentals. By 2020, Netflix hit over $540 per share. A $10,000 investment in 2010 became roughly $770,000 by 2020. And if you held just a couple more years through the peak, you crossed 1 million easily. Stock number 3, Tesla, ticker TSLA. In 2013, Tesla was trading around $10 per share split adjusted. Wall Street openly mocked the company. Analysts said Elon Musk was burning cash and the company would be bankrupt within 18 months. By 2023, Tesla had peaked above $400 and was sitting comfortably around $250. A $10,000 investment in 2013 turned into roughly $250,000 to $400,000 depending on when you sold. And if you'd added even modestly during the dips, crossing $1 million was very real. Stock number 4, Nvidia, ticker NVDA. This is the one everyone's talking about now, but go back to 2014. Nvidia was around $5 per share split adjusted. It was known as a video game graphics card company. That's it. By 2024, Nvidia hit over $140 per share. A $10,000 investment in 2014 became approximately $2.8 million by 2024. And stock number 5, the most insane of them all, Booking Holdings, ticker BKNG. In 2003, Priceline, which became Booking Holdings, was a near-dead dot-com survivor trading at about $6 per share. Most people thought it was going to zero. By 2013, it was trading at over $1,000 per share. A $10,000 investment in 2003 became roughly $1.6 million by 2013. 5 stocks. 5 completely different industries. 5 companies that took ordinary money and made life-changing wealth. So the question isn't whether these stocks exist. They clearly do. The question is, why does almost nobody actually catch them? Here's where it gets interesting, because the answer isn't about intelligence or insider information. It's about psychology. There's a researcher named Hendrik Bessembinder at Arizona State University who published a study in 2018 called "Do Stocks Outperform Treasury Bills?" And what he found completely rewires how you should think about investing. Bessembinder analyzed every single stock that traded on U.S. markets from 1926 to 2016, almost 26,000 stocks across 90 years. His finding? Just 4% of stocks accounted for all of the net wealth creation in the entire stock market. Let me say that again. 4% of stocks created 100% of the gains above what you would have made just holding treasury bills. The other 96%, they collectively returned about the same as cash. A huge chunk of them actually lost money. So when you hear someone say picking individual stocks is hard, they're not exaggerating. They're describing a math problem where 96 out of 100 lottery tickets are duds, and 4 of them are worth millions. But here's where the psychology comes in, because even when people do buy the right stock, they almost always sell too early. There's a behavioral finance concept called myopic loss aversion, pioneered by Richard Thaler and Shlomo Benartzi. Thaler won the Nobel Prize in Economics in 2017 for related work. What they found is that humans feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. So when a stock you own drops 30%, your brain panics. It screams at you to sell to protect what you have left. Now think about every stock I just mentioned. Netflix dropped over 75% in 2011 and 2012 before its real run started. Anyone who panic sold during that drawdown missed the entire 100 bagger. Tesla had at least 5 separate drawdowns of 30% or more between 2013 and 2023. 5 times your stomach would have been in your throat. Nvidia dropped roughly 65% in 2022 alone. A lot of investors who'd held since 2014 finally tapped out, right before it 5x'd. Monster, Booking, all of them had multiple gut-wrenching drops along the way. So the real reason almost nobody captures these returns isn't because they couldn't pick the stock. It's because their brain wouldn't let them hold it. There's another study worth knowing about. Fidelity reportedly conducted an internal review of which accounts performed best between 2003 and 2013. The result became finance folklore. The accounts with the highest returns belonged to investors who were either dead or had completely forgotten they had an account. Now Fidelity has never officially confirmed this study, so take it with a grain of salt. But the underlying point is backed by real data. A 2020 study from DALBAR found that the average equity investor earned about 5.35% per year over the prior 20 years, while the S&P 500 returned over 7%. The gap is almost entirely explained by buying high, selling low, and constant tinkering. So the mechanism is clear. The stocks exist. The math says 4% of them will create generational wealth. But the human brain is wired to sabotage you the entire way there. Which brings us to the practical question. What do you actually do about it? Here are the 4 concrete shifts that, in hindsight, would have caught most of these monster stocks. Shift number 1. Look for category creators, not category followers. Every single stock on this list created or dominated a new category. Monster didn't compete with Coke. It created the energy drink category alongside Red Bull. Netflix didn't compete with Blockbuster. It killed the video rental category and birthed streaming. Tesla didn't compete with Ford. It created the modern EV category. Nvidia didn't compete with Intel. It created the GPU accelerated computing category. Booking didn't compete with travel agents. It ate their entire industry. The actionable rule? Before you buy any individual stock, ask one question. Is this company creating a new category or taking share in an existing one? If the answer is just taking share, your upside is capped. The 100 baggers come from creating new pies, not fighting over existing ones. Shift number 2. Use the 5% rule for individual stock exposure. Look, I just spent 10 minutes telling you about 100 baggers. But Bessembinder's research says 96% of stocks underperform cash. So how do you reconcile this? You cap your individual stock bets at 5% of your total portfolio per position. No exceptions. The other 80% to 90% goes into broad index funds like a total market or S&P 500 index fund. Why 5%? Because if you're wrong, and statistically you usually will be, a 5% position going to zero costs you 5% of your portfolio. Painful, but survivable. But if you're right, and that 5% becomes a 50 bagger, it's now a massive part of your net worth and it changes your life. This is exactly how venture capital works. They know most bets fail. They size positions so the winners more than pay for the losers. Shift number 3, pre-commit to your sell rules before you buy. This is the single biggest defense against the myopic loss aversion problem. Before you put $1 into any individual stock, you write down, in advance, what would make you sell, not if it drops 20%. That guarantees you'll panic sell winners. Instead, write down a thesis. For example, I'm buying Nvidia because I believe GPU demand will grow 30% per year for the next decade. I will sell if either revenue growth falls below 15% for 2 consecutive years, or a structurally cheaper competitor takes more than 20% market share. Notice what this does. It separates price action from your decision. The stock dropping 60% in a panic doesn't trigger a sale. The thesis breaking does. Every investor who held Tesla, Netflix, or Nvidia through their brutal drawdowns had one thing in common. Their thesis hadn't broken. The stock price was screaming, but the underlying business was fine, so they held. Shift number 4, the 20-year holding box. This one is uncomfortable, but it works. When you buy an individual stock, you mentally label it as locked away for 20 years. Not 2, not 5. 20. Why? Because the data is brutal here. According to research from JP Morgan Asset Management, missing just the 10 best days in the market over a 20-year period cuts your returns roughly in half. Missing the 20 best days cuts it by more than 70%, and those best days almost always happen within 2 weeks of the worst days. So if you're trading in and out, trying to time the bottom, you're statistically guaranteed to miss the days that actually create your wealth. The 20-year box forces you to think like an owner, not a trader. When Amazon dropped 95% from 1999 to 2001, the people who made fortunes weren't the ones who timed the bottom. They were the ones who simply never sold. If you can combine these 4 shifts, category creators, the 5% rule, written sell criteria, and the 20-year box, you don't have to be smarter than everyone else. You just have to be more patient and more disciplined than 96% of investors, which, given the data, is a much lower bar than it sounds. So let's bring it all home. We started with a number that should have stopped you cold. $10,000 in Monster Beverage in 2003 became more than $9 million by 2013. And Monster wasn't alone. Netflix, Tesla, Nvidia, and Booking all delivered life-changing returns to anyone who held on. Then we looked at why almost nobody actually catches these stocks. Bessembinder's research shows that just 4% of all stocks create 100% of the market's wealth above cash. And Thaler's work on loss aversion shows that the human brain is literally wired to sell winners during the exact drawdowns that precede the biggest gains. And finally, we covered the 4 shifts that change the math in your favor. Hunt for category creators, not category followers. Cap individual positions at 5%. Pre-commit to your sell rules in writing. And mentally lock every position in a 20-year box. Here's the part I want you to actually remember. You don't need to find all 5 of these stocks. You don't even need to find one perfectly. You just need to find one good company, size it correctly, and have the patience to actually let it work. Because somewhere out there right now, trading at some unremarkable price is the next Monster, the next Nvidia, the next Booking. It probably looks boring. It probably has analysts dunking on it. And in 10 years, people will say, I wish I'd bought that. The difference between those people and the ones who actually did is rarely intelligence. It's almost always temperament. If this video helped you think differently about long-term investing, do me a favor and hit that subscribe button. I make videos like this every week, breaking down the data and the psychology behind real wealth building. Not hype, not hot takes, just the stuff that actually works over decades. Thanks for hanging out with me. I'm Joe, and I'll see you in the next one.